so in love with you.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and more forecasters that are pricing in a recession are now calling for up to a 20% price decline, which is exceptionally exciting news, especially if you're a first-time home buyer that's on the sidelines waiting for a deal of your lifetime, which is exactly what I'm saying is going to happen right around the corner, so long as you prepare. So what we're going to do today, you guys, is we're going to deep dive into an article from Yahoo Finance titled, "A U.S. Housing Recession Has Arrived, and It Could Lead to a 20% Decline in Home Prices and Fed Interest Rate Cuts by 2023, Chief Economist says." Now, you guys remember, I'm not your financial advisor, even if I want to be, even though my bio is as a parent that's worried, a husband that loves his wife, that's trying to step up with the dishwashing, I know that, and laundry folding, realtor, loan officer, instructor in real estate in Texas, also victim of my bad decisions of 2008, had a foreclosure, bankruptcy, repo, and tax lien as a result, and homeowner. But regardless, you guys, do me a favor, because this is my personal YouTube channel. Like this video just for that intro if you didn't skip ahead, and comment below. Subscribe if you haven't. But regardless, let's get started right now. All right, y'all. So a couple important bullet points to start off with. A recession in the U.S. market has already arrived as mortgage rates soar, according to ING Chief Economist James Knightley. Bullet point 2, demand for mortgages has fallen 30% year to date, and sale transactions are beginning to slow. A housing market downturn will weaken the U.S. growth story, but it is also important to remember it will dampen inflation too, Knightley said. So obviously mortgage demand is down 30% because people can't afford houses anymore. Not only can they not afford houses anymore, they can't even qualify for a loan anymore because these interest rate hikes are bringing their mortgage payments way too high. And you guys remember me telling you that when I started to do my paperwork again, to check numbers and check my financial situation, I noticed that houses that I was looking at are now $1,000 more per month on my mortgage payment, which is astronomical. But regardless, let's hop back into the article right now. And you guys, this is some really good information to put things in perspective. Knightley highlighted that near 7% mortgage rates have led to a steep drop in demand for homes due to affordability being stretched to the limit. The higher mortgage rates, which have doubled over the past year, mean the typical monthly payment has surged to $2,600 per month from $1,550 just a few months ago. That represents over $1,000 increase, you guys, per month in just a few months. I mean, don't buy a house right now. I mean, do y'all see this? Do y'all see the reset happening? Let's continue. On an annual basis, this equates to 43% of the median pre-tax household income before tax gross income. By point of reference, the typical new annual mortgage payment for a home purchase equated to 26% of median incomes in the fourth quarter of 2019 and 37% at the peak of the housing bubble in 2006. So insane right now. It is insane. Mortgage applications are down about 30% year to date, and home sales transactions are beginning to show signs of slowing down. At the same time, supply for new homes for sale is likely to rise as housing starts and building permits surged to 16-year highs at the start of the year. So, you guys remember me saying all the time that new builders, new construction builders are in big time danger of essentially going bankrupt because they cannot sell their houses. But the good news is they have a lot of wiggle room on their price to go down. So before they go out of business, what will happen? They're going to gut their prices. And I suspect that we are all going to start seeing that in the nearing months and into 2023. Let's hop back into the article right now. The combination of falling demand and rising supply means home prices are likely to turn considerably lower. In fact, the most recent data from the Case-Shiller Index showed that yearly home price growth decelerated at the fastest pace on record, you guys, on record in July, with some of the hottest markets seeing month-over-month declines. We have only had one monthly fall in home prices, but with more supply coming on the market at a time when demand is weakening rapidly, implies that prices fall further. With housing valuations looking stretched based on the ratio of existing home prices to median household income, he estimated that prices would have to fall 20% from peak to trough for the ratio to get back to its long run average, you guys. So he's calling for 20%. If houses go down, prices go down 20%, you guys know that I win big by renting. If they go down 15%, I still win by renting. But regardless, I absolutely hate renting. It is what it is. Let's continue. But don't expect an imminent housing decline to mirror what happened during the 2008 global financial crisis. That's because household balance sheets are in good shape, with household assets having doubled to 163 trillion since their pre-2008 peak, which essentially means, in my opinion, that we can afford higher price declines than 2008. If we're better off in as far as our balance sheets and household assets, that means we can go down more, right? Y'all see that? Y'all see my logic? Meanwhile, household liabilities have risen just 5 trillion to 19 trillion over the same time period. And on top of that, the proportion of equity that homeowners have in their property stands at the highest level since 1983 at 70.5%. So let me ask you guys, of that 70.5%, how much do you think is going to get wiped away? How much do you think is going to get wiped away from this price correction that we are going to face, that we are clearly getting warnings and red flags being thrown from the Federal Reserve? And after midterm elections, I'm hoping that there's going to be a lot less political pressures on the Federal Reserve. And that may have been what happened in July when the market softened and got us in a little bit worse of shape. But let's get back into the article and let's finish it out right now. With financial regulations having been tightened significantly since the global financial crisis, the risk of a catastrophic loan losses and major strains on the U.S. financial system, even under a scenario of 20% price falls, appears small. And that's my point, you guys. We can handle a 20% price decline, whereas the last time we didn't handle that well at all. We're in better shape now. Think about that. Falling home prices are ultimately a good thing for first-time home buyers and others who want to buy a house, as the housing market transitions to a buyer's market from a seller's market for the first time in years. Falling home prices are also a good sign for the Fed, which is watching for potential signs that inflation tied to housing and rent has peaked. The Fed wants a correction, Knightley said. A housing market downturn will weaken the U.S. growth story, but it is also important to remember it will dampen inflation too. He concluded, we may be soon getting to a turning point in the annual rate of change in these key CPI rent components, which, if so, can meaningfully depress consumer price inflation through 2023 and likely contribute to getting the U.S. inflation back towards 2% by the end of 2023. While the Federal Reserve is downplaying the possibility, we are firmly of the view that interest rate cuts will be on the table in the second half of 2023. So do me a favor, you guys, comment below right now and let me know if you think that the Fed is going to pivot midway through 2023. Personally, I think they're going to, and I hope they're going to make it to the end of 2023, but I want you guys to comment below and let me know what you think. Now the question is, what do you do with all of this data? Now, number one, you stay encouraged. Stay encouraged. We're clearly seeing and knowing now we're going to have a price crash. And we want a price crash. It's way better to buy a home that's way lower in price and get a higher interest rate than the reverse. But the other thing, you guys, become an expert housing market. Start putting in the work and don't stop. And remember, credit. Maximize your utilization ratio. Make sure all of your credit cards are well under 30% of the credit line, and understand that credit cards are king when it comes to your FICO score improvements or credit score improvements, not counting bad things and derogatory information. Second thing is save more of your money. Figure out how you're spending. Download an app like mint.com. I canceled subscriptions and going out to eat, and I saved thousands. The other thing, you guys, income. Get another job. We've never had so much opportunity to make money and grow. So not only find another job, work overtime and become a solid asset at your employer and have a great mindset. Now, other than that, you guys, I really, really hope you guys got value from today's video. And if you're out there investing in real estate, I wish you luck and I hope you win.